President Biden taking aim at America's wealthiest with a new billionaire minimum tax. That news coming out over the weekend. And Robert Frank joining us now with more of the details. Robert, the debate, I don't want to say it's just beginning. It's continuing.
Yeah, it's continuing, especially when you add in your great reporting on the share buyback. Clearly, the White House sending a message to those at the top. Now, this tax is called the billionaire minimum income tax, but it actually applies to households with $100 million or more in net worth. So that's roughly the top 20,000 households. It's really a two-part tax. The first part is a minimum tax of 20%. That's a minimum tax rate. So if they currently pay a tax rate of 12%, they would owe an additional 8% on their income. It also redefines income to include unrealized capital gains. So each year they would pay up to 20% on the increase in the value of stock or a business, even if they never sold. Now, they would have several years to pay this tax. So if a stock goes up 1 year and down the next, they would get a credit against the future payment stream. So let's take, as an example, Mark Zuckerberg, because that stock has been all over the place. He was worth $128 billion at the end of last year. So for 2021, he would owe 20% of that, or $25 billion of that total, as a one-time tax. Now, going forward, he only pays for the annual change based on the stock price. This year, he's down $41 billion, so he gets a credit of $8 billion, leaving him with a $17 billion balance with the IRS. Now, if he ever sold his stock, these payments would be credited toward his future capital gain. So in effect, this is more like a prepayment of capital gains rather than an additional wealth tax or an annual wealth tax. The White House says the plan would raise $360 billion over 10 years. Half of the revenue would come from America's 720 billionaires. And I would bet most of that comes from just a handful of these tech guys that have just accrued huge unrealized gains over their lifetime. Andrew?
Robert, so here's the question, though. For somebody like a Mark Zuckerberg, who, and I don't want to claim he's cash poor, but for somebody like him, given the amount of shares he has, wouldn't he be required effectively to sell a huge component and part of those shares in year one, irrespective of what happens in year 2, 3, and 4, to pay for the initial outlay? Am I wrong in how this would work?
Well, only because the White House says that you would have, at least for that first one-time lifetime accrued gains payment, you would have 10 years to pay that. So presumably, and we'll get the details later today, that would be 10% of that total tax bill every year. So that would be fairly manageable if you could borrow against your stock and not have to sell, or at least not have to sell a significant amount. Now, for the annual payment for each change every year, you have 5 years to pay that. So you've got 10 years for the first sort of lump sum, and then 5 years for each annual change payment. So they spread these out enough, number one, so that they won't have to sell stock. And number two, you create a payment stream where you could balance it against credits and down years.
Right.
Shepard Smith here. Thanks for watching CNBC on YouTube.